5 days ago, JPMorgan did something they never do. They publicly called the top on silver. Not a correction, not a pullback. They said silver will crash from $87 today all the way down to $50 by the end of this year. That's a 42% collapse. The same bank that's been quietly accumulating silver for over a decade just told the entire world to sell. And here's the part that should make you furious. They made this call exactly 1 week after silver crashed 40% in a single day. The timing wasn't random. The message wasn't advice. This was a signal. And if you understand what JPMorgan has been doing in the silver market for the last 15 years, you'll see this for exactly what it is. The setup for the greatest wealth transfer in precious metals history. I know you're confused right now. You watched silver rally from $26 to $121 over the last year, a 365% gain. The metal finally broke free. Everyone said this was it. The squeeze, the moon, and then January 30th happened. Silver crashed 40% in 6 hours. You lost money, or you got margin called, or you sold at the bottom in panic. And now JPMorgan is on CNBC saying it's going to $50, telling you to get out while you still can. They're using their former chief strategist, Marko Kolanovic, to deliver the message. A man who spent decades at the bank, and his words are crystal clear. Silver is almost guaranteed to drop 50% within a year. That's the headline. That's what they want you to believe. I'm going to show you why that headline is the lie, and what JPMorgan is actually doing right now while everyone is selling. Let me take you back to December 2024. Silver is sitting at $28 per ounce. JPMorgan releases their 2025 outlook. They forecast silver will rise to $36 to $38 for the full year. A modest prediction, conservative, nothing crazy. Then 2025 happens. Silver doesn't go to $38. It goes to $83 by December, a 197% gain. JPMorgan's forecast was off by on 18%. They were either completely wrong about the biggest silver rally in history, or they knew exactly what was coming, and they lied. Now fast forward to January 2026. Silver hits $121, all-time high, the biggest monthly gain since 1979. And on January 26th, 5 days before the crash, Marko Kolanovic goes public. He says silver is in a bubble. He says it's driven by meme traders and geopolitical fears. He says it will trade at half its price within a year. 4 days later, silver crashes 40% in one session. Perfect timing, perfect prediction, or perfect coordination. Here's what they're not telling you about Marko Kolanovic. He's the former chief strategist at JPMorgan. He left the bank in July 2024 after 19 years. But leaving doesn't mean leaving. Wall Street doesn't work that way. When you spend 2 decades at a bank building relationships, managing billions, advising institutions, you don't just walk away and forget everything. You know where the bodies are buried. You know the playbook. And when JPMorgan needs someone with credibility to deliver a message to retail investors, someone who doesn't officially work for the bank anymore but still carries the weight of the name, you make a call. Kolanovic's prediction wasn't analysis. It was a press release disguised as independent research, and the timing proves it. Let me show you what JPMorgan has been doing for the last 15 years while everyone was distracted. From 2008 to 2016, JPMorgan held the largest short position in silver futures in the world. They were on the short side of over 200 million ounces at one point. Every time silver tried to rally, they would flood the market with paper contracts, driving the price down. In 2020, the CFTC fined JPMorgan $920 million for spoofing and manipulating gold and silver markets, the largest fine in CFTC history. The order specifically stated that JPMorgan traders placed fake orders to deceive other market participants and profit from price moves they created. That's not speculation. That's federal record. And here's the key. The manipulation didn't stop. It just changed form. Between 2011 and 2020, while JPMorgan was shorting silver on paper, they were doing something else in private. They were accumulating physical silver, hundreds of millions of ounces. According to COMEX vault data and industry analysis, JPMorgan has stockpiled somewhere between 600 million and 1 billion ounces of physical silver. That's more than most countries produce in a decade. They were buying every ounce they could find at an average cost estimated around $18 to $22 per ounce. And they did it quietly, no headlines, no press releases, just month after month of withdrawals from COMEX vaults into JPMorgan's private storage. By December 2025, analyst reports confirmed that JPMorgan had closed their massive short position and flipped fully long, 750 million ounces long. The biggest position reversal in commodity history, and nobody talked about it. Now let me connect the dots. JPMorgan accumulated silver for over a decade at $18 to $22 per ounce. Silver rallies to $121 in January 2026. They're sitting on unrealized gains of $75 billion or more. That's not a typo. $75 billion in profit on a single commodity position. But here's the problem. You can't sell 750 million ounces into a rising market without crashing the price. You need buyers, lots of buyers, desperate buyers. So what do? You create the crash first. You coordinate with exchanges to raise margins 4 times in 6 weeks. You time a Fed chairman announcement to reverse market sentiment. You have China step back from buying at the critical moment. You crash the price 40% in one day. Retail panics, retail sells, and then you have your former chief strategist go on television and tell everyone it's going to $50. You make them believe the bottom is still coming. And while they're selling in fear, you're quietly unloading your position into their panic at prices 300% higher than what you paid. Here's the smoking gun. On January 30th, the day of the crash, silver traded 531 tons of paper contracts in Shanghai. But physical silver withdrawn from vaults that day? 0. The crash was entirely paper. No metal moved. Then February 1st and 2nd, JPMorgan's trading desk shows unusual activity. According to COMEX data, there were significant long position reductions in silver futures during the exact window when retail was panic selling. They weren't buying the dip. They were selling into the dip, using retail's fear as their exit liquidity. And now Kolanovic is telling you $50 is coming. He's telling you to sell. He's giving you the perfect excuse to get out before you lose even more. And every single ounce you sell, someone is buying. That someone is the institution that just made $75 billion and wants to lock it in before you realize what happened. Let me show you the exact same playbook from 2011. Silver rallied from $18 to $49 in the first 4 months of 2011, the biggest rally since 1980. Retail investors were piling in. Then, May 1st, 2011, the CME raised margin requirements 5 times in 9 days. Silver crashed from $49 to $26 in 2 weeks, a 47% collapse. Media said it was a bubble. Analysts said silver was going back to $20, and retail sold in panic. What happened next? JPMorgan and other major banks covered their short positions at the lows and accumulated physical at a massive discount. Silver spent the next 13 years recovering. The people who sold at $26 never got back in. The people who held or bought the dip made generational wealth when silver finally broke $50 again in 2024. The same pattern, the same players, the same outcome. They crash it, they scare you, they buy your metal, and they do it over and over because it works. Now let me ask you something they don't want you thinking about. If JPMorgan really believes silver is going to $50, why did they accumulate 750 million ounces over the last decade? If silver is overvalued and heading for a collapse, why didn't they sell at $80 or $90 or $100? Why wait until after the crash to start telling people to sell? And why use a former employee who no longer officially represents the bank? Because they need distance. They need plausible deniability. If Kolanovic is wrong and silver goes to $150, JPMorgan can say he doesn't work here anymore. If he's right and it crashes to $50, they can say, see, we warned you. Either way, they win. And you lose, unless you see the game. Here's what the data actually shows. Physical silver premiums are still elevated. Dealers are charging $8 to $12 over spot. Delivery delays are 4 to 6 weeks. India silver prices are $95 per ounce, while paper shows $87. That's an $8 premium. Tokyo is $98. The physical market is not behaving like a market that's going to $50. It's behaving like a market where paper and physical have disconnected. And when that happens, the paper price becomes irrelevant. The real price is whatever you can't find the metal for. JPMorgan knows this. That's why they hold physical, not paper. That's why they spent 15 years accumulating while shorting futures. They understood the difference between a contract and a bar. And now they're using that knowledge to transfer your physical metal into their vaults at discount prices. Let me be absolutely clear. I'm not saying silver can't go to $50. Markets can do anything. Manipulation works until it doesn't. What I'm saying is this. When the largest silver holder in the world tells you to sell after they've already accumulated, you should ask why. When a bank with a documented history of manipulation suddenly turns bearish at the exact moment they need to exit a massive position, you should ask why. When the same institution that paid $920 million for spoofing uses a former strategist to deliver a crash prediction 1 week after the crash already happened, you should ask why. Because the answer is simple. They're not predicting the future. They're creating it. And they need you to believe the story long enough for them to finish selling. Here's the part that should terrify JPMorgan. Physical silver supply is the tightest it's been in 50 years. Global silver mine production in 2025 was 843 million ounces. Industrial demand alone was 690 million ounces. That doesn't include investment demand, jewelry, or silverware. The deficit is structural. It's not going away. And when you combine that with the fact that silver is essential for solar panels, electric vehicles, 5G infrastructure, and AI data centers, the long-term case for higher prices is undeniable. JPMorgan knows this. That's why they accumulated. But they also know that in the short term, fear is more powerful than fundamentals, and fear is what they're selling right now. Through Kolanovic, through headlines, through coordinated crashes, they're weaponizing your emotions against you. And it's working. Now you know what's happening. JPMorgan flipped. They went from the biggest short to the biggest long. They made $75 billion or more on paper. They crashed the market to create panic. And now they're using a former strategist to tell you it's going to $50. So you'll sell them your metal at $87 instead of $120. That's not a prediction. That's a plan. And the plan only works if you believe the story. So here's my question for you. Are you going to sell to JPMorgan at $87 after they bought at $20? Or are you going to do what they did for 15 years and accumulate while everyone else panics? Because one of those decisions builds wealth and the other one transfers it. The choice is yours. If this video showed you what's really happening behind JPMorgan's $50 call, share it with one person who's thinking about selling silver right now. One person who got scared by the headlines. One person who deserves to know that the biggest silver holder in the world doesn't want you holding silver anymore. And ask yourself why. Drop a comment below and tell me, do you believe JPMorgan's $50 prediction, or do you think they're setting up the exit? I want to know what you're seeing in your market. This is the game. Now you see the players. What you do next determines which side you're on.